Hello everyone. Cheryl and Heather Walker. This is I want to say welcome to my accounting course, my accounting channel. And first, I want to start out with let's start out with some definitions, so we can make ourselves acquainted with accounting, what accounting is, and what the course gonna call, what the course will call for. Okay. First, what is accounting? Accounting is a system that measures business activities, processes that information into reports, and communicates the results to decision makers. So, in other words, it's a system that measures business activities. So, those business activities could be, in other words, say for instance, you're a company and or you're a company, you're a business, you're a corporation, partnership, LLC, or whatever you have, and in other words, you started your business with $100,000 and you invested into that goes into your owner's equity. So that would be a business transaction. Then you might have another transaction. Uh, you bought some land. Say for instance, business owner, you bought some land, $50,000 for this land and this building. Land 50,000, building 50,000. So those are transactions. All those transactions have to be recorded at the end of the accounting cycle, and once they're recorded, then that's where your accounting department would prepare your income statements, your balance sheets, and your statement of owner's equity and your statement of cash flows, with using those transactions. So those are the transactions that's within a corporation or within a business. In other words, managers will be responsible for making sure that all these transactions are recorded, properly. Well, actually, the accounting department will do that, but managers will make sure internally. In other words, within the organizations, that's what they call managerial accounting. So the managers have to be responsible for making sure that those transactions are taken care of, and the accounting department and other departments are running smoothly within that organization. So then you have your financial accounting. That's for your outside in other words, your outside decision makers, your auditors, your SECs, your security and exchange commissions, your credit unions, your banks. So that would come under financial accounting. So in other words, if you was trying to get a loan or something for your company, your business or corporation, whatever type of business you're running, you try to get a loan, they're gonna want to look at your income statements, your balance sheets, your statement of owner's equity, your statement of cash flows. They're gonna want to see how much money you have coming in, how much money you have going out, your revenues, your expenses, your accounts payables, all those type of things. So, and the next term I have is, so when you dealing with accounting, you definitely want to know what, let's start out. First of all, you want to know about the accounting equation. The initial accounting equation is assets equals liabilities plus owner's equity. So that's the initial equation. Assets equals liabilities plus owner's equity. So in other words, when you got your business, you want to add up all your assets, which may be cash, accounts receivables, accounts receivables. You might have land, building, accounts receivables, land, buildings. You might have supplies. And I will put under here prepaid rent. might have prepaid rent, prepaid insurance. Depends on your company, depending on what type of accounts you have in your business. If you may be running say for instance, you running the cleaners or you running a car dealership, whatever type of business you have, that will depend on, the accounts that you do have. And so assets, you would have all your assets and you add them all up and you get a total. And then you have your liabilities. In other words, your accounts payables, all your liabilities, all your payables, accounts payables, interest payables, and all your payables will be your liabilities. So once you add all them up, then you have your owner's equity, and your owner's equity will come from your statement of cash flow. So once you add all your liabilities up, and then you add your liabilities to your owner's equity, you take your liabilities and you minus them from your owner's equity, and then that's where you get once you get that total should equal your assets. Your assets should equal that. So that's assets equals liabilities plus owner's equity. Owner's equity. So that would be that. In other words, if your liabilities are, say for instance, your assets, oh boy, this is a little wet, but assets, say for instance, your assets are $110,000. Then you got your liabilities plus your owner's equity. So your liabilities could be, say for instance, your liability. So it will have to equal your assets, whatever that is. So you have to make sure this side equals this side. So liabilities could be, say for instance, 90,000. Liabilities could be 90,000, and then you take your 90,000, and your owner's equity may be 20,000. See, so in other words, assets 110,000, say this is your liabilities 90,000, and your owner's equity was 20,000. So when you add that together, you're gonna get the same thing. 110,000 on both sides. So let's see what other terms we have. Okay, owner's equity. We did that one. Okay, so in other words, before we get to our C accounts, we definitely want to know the certain terms. So we'll have accounts receivable. We have accounts receivable. We have accounts payable. And we have note payable. And we have revenues and expenses. And then we have, that's it. Okay, so in other words, I put these terms up here because these terms are very important when we get to the T accounts. See, T accounts, when we get to the T accounts, we have a debits on the left and credits on the right. Say for instance, we have a cash account. We have supplies. We have accounts payable. We might have a land account. Okay. In other words, let me explain these terms here. Accounts receivable. In other words, you have accounts receivable. You create accounts receivable. In other words, you're a company, your business, your corporation, partnership, whatever company, kind of company you're running, LLC, a limited liability company. So in other words, when somebody purchased If somebody purchased something from your company on account, in other words, they create a credit account. When they come to your company, they might say, hey, let me order, I want to order 100 computers, and they don't pay right away. They want to pay within 30 days, with 60 days or 90 days. So they're creating accounts payable because they're going to have to pay you. But once you start receiving it, then you put it down as accounts receivable. So accounts receivable, so that's how you create accounts receivable. So it's accounts payable at the beginning because they may say, hey, I want to pay, I want to write it down. Can you write it down? Then you create a notes payable and a notes receivable. If it's written down as a promissory note and they're not paying right away, so that's a notes payable or a notes receivable. So accounts receivable, in other words, that's a promise to pay. So in other words, somebody come in your company, they want to buy something, they want to purchase something, they say, well, I'll pay you 30 days. I want to pay in 30 days or 60 days or 90 days. So it's basically a promise to pay at a later date. So accounts payable, same thing. A promise to pay at a later date. Accounts payable. And then also, if you go to a company, you're a company, but you can also go to another company, and you might say, hey, I need some inventory for my company. I want to create accounts payable. I'm not going to pay for it all at one time. So they're creating accounts payable. So actually they're creating accounts receivable. You are creating accounts payable, but you're going to have to pay. You're going to have to pay in the future. So that's what that means. They're creating, in other words, you say, hey, I want a certain amount of computers or whatever you're selling, fur coats or whatever you want to purchase for your sales in your company. You're creating accounts payable because you're going to have to pay it in the future. So it's a promise for you to pay. You're creating a promise to pay. They will be creating on their books accounts receivable because they're going to be receiving the funds from you in the future. And then that's what I'm saying. I'll just mention this notes payable is the next term. So if it's written down as a promissory note, they call it a promissory note. That would be a note payable. So that means you're agreeing to a promise to pay them in the future because you went in there and you bought some inventory for your company or whatever you went in there to purchase. So in other words, you create a note payable when it's written down as a promissory note. So they have a promissory note, you probably sign it, you might make a down payment and you say, hey, I promise to pay in the future. So that's a note payable when it's written down. But other than that, it's accounts payable. And then we have revenues. In other words, revenues are all the income you have coming in from sales. You have sales revenue, interest revenues. You have cash. That could be considered revenue. Your accounts receivables, all your accounts receivables for your company is revenues. Can be added up for your revenue. So revenues minus expenses, that's what goes on the income statement. So in other words, you add up all your revenues, then you minus your expenses off your revenues, and that will give you your net income. That's on the income statement. So I'll talk about that a little later. And the last one is expenses. So in other words, your expenses, your rent, your electric, your rent, your salaries payable, you have to pay your employees, all those come under expenses. So your expenses, so in other words, I have to pay utilities, rent, I have to pay my secretary, I have to pay my, whoever I pay, I have to pay my employees. Say for instance, I had 50 employees, I had to pay all of them. So, accounts receivable, accounts payable, note payable, revenues, expenses. So then when you're looking at the T accounts, you think about so when I'm looking at the T accounts, I say say for instance we have a T account cash. In other words, you want to say the initial usually we start out I know when I first learned accounting, the first transaction I learned in the book was own invested $50,000. Owner invested $50,000 in the business. So in other words, if the owner invested $50,000 in the business, you'll have a debit to cash, because when you're dealing with an asset account such as cash, you want debit on the left side for an increase, credit on the right side for a decrease. So this is the initial transaction that I learned when I first started accounting. $50,000, I think it was Gary Lyon in the book. And I can also use my own company. Or you can just say, you can make up a company. Cheryl's Fur Coat Manufacturer. Or Cheryl's Fur Coat LLC. Fur Coat Sales LLC. $50,000, so I want to debit cash $50,000. Because it's debit cash, that's money coming into my company. I just invested. I'm the owner. I invested $50,000. So $50,000 in my business. I want to debit cash $50,000. Also, I'm gonna have to credit my owner's equity account $50,000. Credit owner's equity $50,000 because I invested $50,000 in the business, and it's also going into my owner's equity. So that's how much equity I have in my business. So that's the first transaction that I learned. So let me erase these right here. Bring them all to the other side. So also, so in other words, as I said, that's a cash account. Okay, that was a cash account, but this is a new one. Okay, so let's say I invested $50,000 in my business, and I invested $50,000 in my business, as I said, in our transaction. So that's $50,000. So I debit cash $50,000, and that's it, because that's a debit for increase, and credit for decrease. And then I had over here owner's equity $50,000. Okay, now using these same two accounts, what if I went and said, hey, now I invested $50,000 in my business. So $50,000 I debit cash, because like I said, with an asset account, you want to debit on the left side for increase, credit for decrease. In other words, each T account, these are T accounts. So you have debits and you got credits, and then you have debits and credits. Each T account is going to be the same thing, debit and credit. Debit on the left, credit on the right. But you just have to figure out which account, which side do you decrease on, and which side do you increase on. So it's in the book. But I'm going to tell you, if it's an asset account, we debit on the left side for increase. And cash is an asset account. We debit on the left side for increase. And we credit on the right for a decrease. But when it comes to a liabilities account, like accounts payable, interest payable, we want to credit on the right for increase. See, in other words, when it comes to accounts payable, we credit on the right side. We credit on the right for increase. And we debit. We want to debit on the left for decrease. So it's the opposite. This is a liabilities account. Accounts payable is a liabilities account. So I want to credit on the right for increase with a liabilities account, but with an asset account such as cash. We have cash, accounts receivable, interest, prepaid rent, prepaid insurance. We want to debit on the left for increase. So in other words, if you're taking an asset account, let's take another asset account, like so say for instance we take another asset account. Okay, we take two more asset accounts. In other words, so if I say I want to debit on the left side, I have an asset account. I want to debit on the left side for increase. So say for instance, I have asset account land, and I have an asset account supplies. So if I have an asset account land, and say for instance, my company, I invested $50,000 in my company. So that was a previous transaction, $50,000. I debited cash $50,000 for debit for increase, and I credit owner's equity. I credit owner's equity $50,000, and that was for increase too as well. But this is land. Say for instance, now I want to purchase some land for my company. 20,000 land. So land is an asset account. So as I said previously, if I want to increase my asset account, I'll make it a debit. So in other words, land 20,000. So I want to debit my land account, $20,000. So I purchased land, $20,000. So also I want to come over here and I want to purchase some supplies for my company. Say for instance, I just want to spend about $2,000 maybe. So when I purchase $2,000 worth of supplies. $2,000 worth of supplies. So since supplies is an asset, I'm gaining an asset. So I wanna debit supplies $2,000 because supplies is an asset, land is an asset. So see how I debit for increase in both of these accounts. So that's how they go. So those are asset accounts. So then what if I have accounts receivable, which is an asset account? So what if I have accounts receivable? Accounts receivable is an asset account, and what if I want to purchase a building? Say for instance, I have accounts receivable that I just received. So in order to increase accounts receivable, I want to debit that too. In other words, somebody purchased some supplies for my company, and now they just decided to pay. So they paid me $500. They paid my company $500. So I'm going to debit my accounts receivable account because accounts receivable is an asset. And as I said, previous transaction, to increase an asset account, you want to debit on the left. And then what if I purchase a building? I want to use this building. I want to use the building to, conduct my business, sales. I'm a fur manufacturer, or I'm just selling furs, fur coats, fur jackets, fur coats. So I purchased that building for. I didn't invest for $50,000 in my business, so I don't want to spend too much on the building. But I could also pay for the building on credit. But if I purchase it all at one time, I might just say, hey, let's say $15,000. It's just an old building, but since building is an asset, I want to debit on the left. See, accounts receivable is an asset, debit on the left for increase. Building, debit on the left for increase. So let's move to a accounts liabilities account. Say for instance, I purchased that building. Say for instance, my company purchased that building. My company purchased that building, and say for instance, is that same building, but I want to do a different transaction. I purchased that building, or maybe I went and found another building, maybe a couple months later, and but I want to pay for it on account. I want to create an accounts payable, and so as I said, I want to increase on the right hand side. So in other words, this is the accounts payable. Say for instance, I want to purchase another building a month, maybe a month later, but I don't want to pay for it all at one time. I just paid for the other building. That was $15,000. So you saw where I debited building for $15,000, but I want to pay for this building right here a month later on accounts payable. I went out there and I found this building, and they said, well, you can pay for it over time. You can take 60 days to pay for it. So I'll create accounts payable. I created an account. I created a credit account with the real estate or whatever company I purchased that building from. So say for instance that building only cost me let's say $20,000. I created accounts payable for that building. So in other words, then I still could debit my building account because I'm still creating an asset. I purchased the building, so when I purchased that building for $20,000, that still gave me an asset. So I want to debit. I still want to debit my building account, but I paid for it. I paid for it on credit, so I want to credit my accounts payable because that's a liabilities account. Liabilities account, so I want to credit my accounts payable because I want to pay for the building on time. But since I purchased it on credit, but I still gained an asset. So building and liabilities. Accounts payable is a liabilities account. So as I said, you asset account, you debit on the left. Liabilities account, you credit on the right. You credit on the right for increase. So we want to debit an asset account on the left for increase. And when it comes to a transaction, each transaction usually affects two accounts. So when you get a problem, sometimes it can be sometimes you can have a double or compound entry. So in other words, you get a transaction, and say for instance, the transaction say paid expenses. Paid expenses. We paid. Let's say we paid rent. Say for instance, we paid rent $600. We paid supplies. Paid for supplies. We paid utilities. Say for instance, you pay rent, you pay supplies, you pay utilities, and you paid your employees. So if we did all that, we just take our T account, and a lot of times most of the time it usually affects only two accounts. So say for instance we have a supplies, say for instance supplies was just something small, $200. Utilities was $1,200, and we paid our employees $3,000. We had a certain amount of employees we had to pay. So what we do, we come over here to expenses, and since we paid them, we want to debit on the left. But if we didn't pay them, we would have credited it on the right hand side. But since we're paying them, so we have rent $600, supplies $700 or $200, and $1,200 for utilities, and $3,000 for employees. So since we paid them, they're our expenses. We want to debit on the left. So, and since I said it always affects two accounts, so if you pay these, then it's going to have to come out the cash account. So, as I said earlier, in the previous transaction, when you debit asset account on the left, that's for increase. But since that's cash coming into the cash account, we want to debit for increase on the left. But since it's cash coming out of the cash account, we want to credit on the right. So what we do, we put them over here, $600 we paid rent, we paid supplies, we paid utilities $1,200, and then we paid our employees. $3,000. So total we paid $3,000, $4,000, $4,400, $4,000. We paid $5,000. So total $5,000. Total is $5,000. Yeah, so in other words, we paid our expenses. Rent, supplies, utilities, and paid our employees. So they came on here our T account. There's a T account for expenses, and then we have a T account for our cash. So we credit cash on the right hand side because we paid our expenses. So they had to come out the cash account. So it always affects two accounts. So okay, I think that is the last one I have for that. Let's see. Okay, these are the terms. I went over those. Okay, let's see what I have here. Okay, so I'm going to step away from the board. And I'm going to step away from the board. I'm going to sit down here for a little bit. Okay. All right, okay. I just want to step away from the board. Sorry about that, a little bit of class. And just want to show you how I have my chart set up. Okay, Gary Line invest $50,000 in the business. This is the same one I put on the board. Okay, say Gary Line invested $50,000 in the business, and so we want to debit cash $50,000, and we come over here. We want to credit on his equity $50,000. And this is the initial accounting equation. Assets equals liabilities plus owner's equity. So the next one is Gary Line purchased land for $40,000. So he purchased land for $40,000. So we want to debit the land account $40,000 because that's an increase in an asset. So that's what that is. See, he purchased land for $40,000. See how we did a debit to the land account, and then when you see where it's a credit to cash $40,000, and it's a credit to cash for you credit cash $40,000. It's a cash account. It's an asset. And we debit the land account $40,000 because it's an increase in an asset, which the asset is a land account. And Line buys stationery and agrees to pay in 30 days. So he bought some stationery. This is just initial equation I put up here. Assets equal liability. This was all his equity. So when you're doing your little transactions, you can put that up there. You can put the initial account. This is the initial accounting equation. So in other words, he bought some stationery, office supplies. So see how I said where you have an asset account, you debit on the left for increase. So he purchased some supplies for $500. So that's an increase in an asset account. And the asset account is office supplies. So since he purchased them, he had to take the money, or he purchased them on account, so it becomes an account payable, a credit account payable. So as I said previously, I just wrote on the board where you credit a liabilities account for an increase. So they increased their accounts payable $500. So that's why they credit accounts payable, and then we debit office supplies because the company is gaining an asset. Okay. And this one here, Gary Line earns revenue $5,500. So collects money in cash. So Gary Line collects money in cash. So in other words, if you collected money in cash uh, from doing some service, a service revenue, collects money in cash, service revenue 5,500. That's why we debit. See, service revenue is an asset account. So we want to debit service revenue, as I said. Just wrote on the board, and then my previous transaction. Uh, Service revenue is an asset, so we want to increase service revenue 5,500. And owner's equity 5,500. We want credit owner's equity. That gives us equity in the business. That gives a Gary Line equity in his business. So the next one is, so Gary Line performs services on account. So in other words, he receives, and also, he receives cash. He receives his revenue. See, that's why I said service revenue 3,000, and then owner's equity 3,000. So it says perform services. Lion receives he receives a promise to pay within 1 month. Receives a promise to pay within one month. So that's accounts receivable. Initially, it will create accounts payable too. It'll create accounts receivable for the company, but for the Gary Line, he will be creating accounts payable for $3,000. So the company will get an accounts receivable because the customer agrees to pay. So when the customer agrees to pay, then that company that they made the agreement with will create accounts receivable. So accounts receivable debit and owner's equity, or credit owner's equity. And then Lion pays $2,700 cash for some expenses. So in other words, office rent, 1,100, employee salary 1,200, and utilities 400. So they came to 2,700. So that still had to come out of the cash account. So expensive. So it came out of cash. So when the company paid those expenses, rent and employee salaries and utilities, that still had to come out of the cash account, 2,700. And then you can also say owner's equity. It comes out of owner's equity. And also, you can create another account for, it could be expenses. Could be another T account for expenses. See? And also you can create another account for expenses. Office rent, utilities, and employee salary come out the expense account. See, it's like a compound entry. Assets, 2,700. See, as I said, with an asset account, you want to credit on the right hand side for decrease. So there's money coming out the cash account. So since those expenses had to be paid, they had to come from somewhere. So they come out the cash account. So that's why we got a cash T account here. See, these are T accounts. That's 2,700. And the expense account all came out of the expense account. Now, if they wasn't paid yet, they would be on the credit side of the expense account. But since they were paid, we want to debit the expense account. Okay, so and a Gary Line performed services for a client on account, and it was $1,000 for $1,000 on account. So in other words, he received this accounts receivable. He received services on account, so that's why we created accounts receivable. That's the money he received, $1,000. And that's why we debit in cash, because as I said in my previous transaction, And when you increase asset accounts such as cash, accounts receivable, you want to debit on the left. So cash was received. The company received their accounts receivable. So that was the promise to pay that the customer created. So once they paid, then they debit their receivables account, and then you can debit your cash because cash money's coming in, cash coming into the business. That's a debit or increase. That's an asset account, cash. Okay, Lion business sells the land and receives $22,000 cash. So when your business sells land, that will increase the cash account. If you sell land, so no, say Lion business sells the land. So they sold the land, they increase their cash account because that money they received from the sale of their land. They sold the land for $22,000. And then you debit the land account because it said the business sells the land. Wait a minute, the business sells the land and receives $2,200 cash. So you know what? If they sold the land, it should be, it's a debit to cash, but this should be, hold up, that may be, it says, Lion's business sells the land and receives $22,000 cash. No, what I want to do, I want to change that to, since they sold the land, they sold it, they didn't buy it. Now, if they would have bought the land, it would have been an increase to the land account. But since they sold it, I want to credit the land account, $22,000. But since they sold it, they did increase their cash because when they sold it, they received $22,000. But since they sold it, they decreased the land account. So I want to credit the land account because they decreased. They got rid of the land. They didn't increase it. So if they would have increased it, I would have debited it. So I'm going to change that. So that's how that one is. So also, it could be also, you could also do owner's equity. It could have been a debit owner's equity because your asset went down. Your equity went down when you sold your land. So it could be, but I think I just use these two accounts. So we're going to credit the land account because we got rid of the land. But we did increase our cash account, our asset account, because we sold the land and we received $22,000. Gary line. So that's $22,000 debit to cash. As I said, the asset account, you debit for increase, and you debit for increase, and you credit for a decrease when it comes to the cash account. Debit for increase, credit for decrease. But so since we increased our cash by purchasing land, so that's what we have. That's what we have on that one. I think this is the last one. And Gary Line withdraws $2,100 from his business bank account. Usually you're not supposed to go into your business bank account, but I guess since that's Gary Lyon's business, so what he did, he withdrew $2,100 out of the cash account. So since this is an asset, as I said in the previous transaction, we want to credit the cash account for decrease. So $2,100 credit for decrease coming out of the cash account. Cash account is an asset. So we're not increasing it, we're decreasing cash because he withdrew. And also, you're supposed to create a separate account called withdrawals. That's what that should be. It should be, instead of owner's equity, I think I do withdrawals. $2,100. So I think instead of owner's equity, instead of owner's equity, we have to create a second account for withdrawals. We want a debit withdrawals account because Gary Lyon, he withdrew $2,100 cash. So since he took money out of the cash account, we want to credit cash $2,100, and then we have to create an account for withdrawals. So we want a debit withdrawal, debit withdrawals account $2,100. So always create a second separate account for the withdrawals account when you withdraw money out the business bank account. Shouldn't have, you're really not supposed to commingle funds, but I guess if he withdraw money out the business bank account, that's his business, I guess, and that's the money he put in his own business. So it would be good if he had a separate account for his business and a separate account for his, in other words, if you want to withdraw some money. But so it would be probably kind of tricky. It would be kind of tricky if he had a partner, and in other words, you two people working in the two people owning the business, and what if you got a problem? Somebody want to go and withdraw some money out the account. So I guess you would have to let the partner know, hey, I need to withdraw some money, so I'll put it back later. But so that's how that went. So like I said, in that second account for withdrawals. So withdrawals. So like I said, we want to debit the withdrawals account, and we want to credit cash because $2,100 came out of the cash account. Gary Line, and sometimes I use my own name. Sometimes you can use your own name. When I'm doing these little transactions, sometimes I say Cheryl's fur coat sales LLC, and say for instance I started my business with $200,000. I would debit my cash account $200,000, credit my owner's equity account $200,000. So because I started my business with $200,000, I'm selling furs, or I'm selling jeans or whatever I'm selling. So that's it for today, class. I want to say thanks for joining me, and hope to see you back here, same place, same time. And I want to try to have some printouts, and I usually like doing these little charts and stuff that I be doing. So I like to do these little charts and stuff. So I want to say thanks for joining me, and I'll see you on my next video. So hope you join my class, and I hope you're learning something. So hope you're learning something. So this is some simple debits and credits, and I want to say thanks for joining me, and I'll see you in my next class and on my next video. So you all have a good one.